Hey, welcome to On the Spot here at FreightWaves Now for this week. Of course, I'm Kevin Hill here with JP Hampstead, our Director of Passport Research. We're going to talk about the spot market in trucking, and it's all about earnings today. We're right in the middle of earnings season, Q2 earnings. C.H. Robinson reported last night. J.B. Hunt's reported. Echo aftermarket closed today. But let's talk about C.H. Robinson right now.
Yeah, so they had a great quarter. They beat, revenue. They beat on earnings per share. Notably, earnings per share, which came in at $1.44 a share. It wasn't because of buybacks, right? Net income increased basically the same amount, and the stock was too expensive for them to justify buybacks anyway. I thought there are a couple of things that are really interesting. One is that NAST revenue. NAST is North American Surface Transportation. That's Robinson's brokerage. It includes truckload, LTL, and intermodal. The other big business unit is forwarding, global forwarding. But NAST revenue was up basically 45% year over year, 12.5% up from the first quarter. So sequentially up 12.5%, which is really strong.
It is. It's strong, and the gross revenues in NAST were up 45% year over year. Q2 of 2020 was very much a down quarter for trucking in the spot market. J.B. Hunt, I think, came in 100% above year over year increase. We'll see what Echo does, but you're going to see really good results, especially on year over year comparables when it comes to that. What about gross margins?
Yeah, so we can actually talk about that in a second. One thing I did want to pull up was that Robinson is highlighting their technology investments. We have a chart that kind of illustrates what they're talking about there. The big claim that they make is that massive investments in technology you'll see on the left-hand side of the screen, the decoupling of NAST volume growth and NAST headcount growth. So that's really important. If you can do more shipments and cover more freight, and grow that number at a rate that's faster than the rate that you're adding people, then in theory you should make more money.
And the graph on the right is a really good illustration of that too, and that's shipments per day per person. And you can see that's rapidly growing. There's the arrow right there is when C.H. Robinson committed to investing in technology, and we see that's paying off.
Yeah, it's paying off. Notably, this y-axis on this chart is not absolute loads, right? So it's not saying that it's 135 per day per person. It's an index. It's indexed to 100 back in 2018. So we can say that it's roughly 35% higher, right? 35% more productive per person.
I thought it'd be nice if as a freight broker, if I could move 135 loads a day.
Well, I think so. One of the questions is, how are they doing this, right? One way is by aggressively selling into LTL freight. So they grew LTL volumes 23.5% year over year. They only grew truckload volumes 6% year over year, right? So they're changing their revenue mix. LTL shipments are much more highly automated. The matching problem is far easier because there's only a certain number of carriers on a lane. You've got all of their published rates. It's a simple matter of choosing, which carrier
it's kind of pick it and click it almost. It's where truckload wants to be.
And of course, there's much less money in the shipment in a typical LTL shipment versus a typical truckload shipment. And I think there's two reasons for this, right? One is that it does make them look more productive. I don't think that's why they're going to LTL, not to pump this sort of.
It's a strong market right now. Why wouldn't you go to LTL? LTL is showing a lot of strength.
It's also a higher margin than truckload. If we pull up this second chart showing NAST, North American Surface Transportation gross margin over time, this goes back to the first quarter of 2016, I believe. So about. Maybe actually 2015, so I think it's 5 or 6 years. You see a pretty steadily decline in gross margin. It almost hit 20% back in the 15, 16 kind of soft market, but now it's at 12.2%, right? is this a secular decline? Is it, what does it really mean?
And when we say secular decline, we mean, is this long-term decline? I think that the answer, from our point of view, right, because we've talked about this quite a bit, is yes, it is a secular decline. Who is not a digital freight broker anymore?
Right. It's not just and it's not just digital freight brokerages, right? It's
those efficiencies that matching technologies bring. The more efficiencies into a market, the lower the margin.
And I just think that it's a different competitive environment than it was back when NAST could hit 18% gross margins, right? Like 6 years ago, there were basically $5 billion brokerages in the country. Now there are 15. So that makes a huge difference when you're talking about the competition over Fortune 500 freight.
Oh yeah, and we've had two big consolidations over the last 4 to 6 weeks. We had Global Trans and Worldwide Express, right? Yep. And then last week it was announced. Yeah, Uber Freight and Train. Uber Freight wasn't even around 5 years ago or 6 years ago in 2015, and now they've purchased Transplates for $2.25 billion, announced last week, and it comes in. Technology is driving margins lower.
Yeah, in some sense, like that top tier of the $5 billion, $10 billion brokerages, may see more people joining that cohort. It may not just be limited to Robinson anymore, but there is a story that we could tell about secular decline of gross margins, narrowing margins, being forced into higher productivity in order to generate operating leverage and things like that. But I was talking to some of my friends in the brokerage community last night about this chart, and they said, well, gross margin percentage is kind of misleading. What you really need to focus on is spread per load, or you could call it net revenue dollars per load, right? So if the rates are screaming higher, right, you could be making twice as much money per load, but your gross margin percentage has shrunken a little bit.
Yeah, so if that load was $1,500, you're paying a carrier $1,200, you're taking in 3. If that's now $2,000 and you're charging $1,650 or something, your net revenue has gone up $50. And I think that gross margin percentage has gone down, if I did my math on the fly here on TV, right?
Yeah, exactly. So that's and really it's net revenue dollars per load or spread per load that's going to determine whether your brokerage is making money or losing money.
And this is the part of the cycle. We use Echo cycle, market cycle as a guide a lot of times. That the ebb and flow is that when spot rates are spiking. Right, it's hard to find capacity. You're going to probably what you think is overpaying for trucks, but you're going to pay a premium for trucks to get those loads covered. Your gross margins percentage is going to decrease. It's going to get tight right in this cycle of the market, but your net revenue is going to go up. Once those contract prices roll, as they roll, things are a little bit normal until they ebb and flow down again.
It's interesting. I read a comment by a Wall Street analyst, Bascom Majors at Susquehanna, saying that he thought that the tone of the call was actually more pessimistic than the results, and they indicated that they thought that truckload capacity would stay tight, that they're seeing, but also on the volume side, they're seeing shorter term mini bids on the part of shippers who look like they are sort of salivating at the prospect of a market downturn, really waiting for rates to fall and really trying to capitalize on that.
We'll see if that plays out. I know that the first carrier update that we did today, Zach was talking about load volume staying pretty solid as rejections fall off. So I mean, we're probably rolling.
Right. So last week, national average driving truckload spot rates on truckstop.com load boards recovered up to I believe it was $3.32 a mile, which is an extraordinary number. Of course, it includes fuel, but that continues to diverge from outbound tender rejections, right? And so we think it's just a matter of time until spot rates correct down, but there's still a lot of uncertainty in this market.
There is. So there's going to be uncertainty for a while. We're coming into peak fourth quarter Christmas season. We're going to see a lot more maritime boats and containers offloaded, goods moving around to different ports that are more spread out. So we're going to have assets probably not positioned in the optimal spots, and we will be we'll be tracking it week after week here on Wednesdays on FreightWaves Now for On the Spot.